Good morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities, and welcome to Monday Minutes. We hope everyone is staying extremely safe and healthy in these unprecedented times, and we wish everyone the best as we start a new and what's likely to be eventful week again. Let's take a look. This morning in our morning notes, we wrote about the three buckets the way we see them right now in terms of crisis. We have the health side, we have the financial liquidity side, and we have the economic side. Now, on the health side, it's pretty clear that cases have not peaked, and we look at New York City as the epicenter, potentially spreading out to other boroughs in New York. We listened to the medical professions over the weekend. Clearly the virus is spreading throughout the country at this point, and cases have not peaked. If you listen to the president's press conference yesterday, obviously last night he extended the guidelines through the end of April, but he actually referenced a June 1st date in terms of having the economy completely up and running. So we continue to see health first here, clearly. But from an economic perspective, we also see a slightly longer time frame versus a shorter time frame. The bigger risk here is opening too soon, having cases resurface, which would be an unmitigated disaster for so many. On the financial liquidity side, clearly we have the Fed. It's only been a week since they announced the extreme emergency measures in terms of extending out into the corporate market, the municipal market, announcing the Main Street lending facilities. It feels like much longer, but it's not. The reality is right now, with the passage of the CARES Act, all eyes will be on Secretary Mnuchin, Chairman Powell, to see what they do in conjunction in terms of increased funding toward these facilities, how they're going to roll these facilities out. But when you look at the markets that the Fed has influenced short term, whether it's $125 billion a day, Treasuries and mortgage-backed securities, mortgage spreads have come in extremely tight right now. If actually these conditions are creating problems in other segments of the mortgage market, they began buying CMBS, they're going to buy corporates, munis, all of the credit products. In particular, you look at the high yield market, you look at which is alleviated a little bit but still has some strains. You look at the investment grade corporate market, you look at the issuance last week, which completely exploded. You look at treasuries, the volatility has come down. So the Fed is clearly having an impact on a liquidity perspective. The challenge for the Fed will be trying to find the right balance of what they're buying versus what the market actually needs. And that is actually coming into play very, very soon here. Keep in mind, for context, QE2 back in 2011, 2010, the totality of that program, the Fed has achieved within 1 week. Okay, so the buying has been absolutely extreme. The Fed's balance sheet now is up to $5.2 trillion. The reserves in the banking system well over $2 trillion. Now let's turn to the economic side. In our opinion, the focus here is small business. We spent a lot of time over the weekend looking at the dynamics of small business. The numbers are enormous. So 60 million jobs, 30 million businesses, 75% of small businesses starting with leverage from the outset to fund their businesses and start up. Small business is a critical component of not only our economy, but what's going on here. And when you look at the claims number from last week, very alarming in terms of an absolute number. Clearly this week may be actually more important than last week, with the expectation of last week for that number to be extremely high. All eyes will be on the claims number for Thursday to see what type of follow-through we see here. But what's critical right now is the rollout of this program. The numbers in and by themselves are clearly large, we know that. But the reality here is we need to get monies into the hands of the businesses that need it right now. Will all businesses take that money? It's not really clear. What will the demand side be on the other side? It's not really clear. But right now, our focus should be on salvaging jobs. These loans will go through financial institutions that have FDIC approved guidelines, and the paperwork, for all intents and purposes, is supposed to be a one-pager and extremely streamlined and to be rolled out on Friday. Right now, our primary concern is the health and safety of the American people and the health and safety of the U.S. economy. The Fed seems to have the liquidity side backstopped, and we'll see what comes out of this week in terms of Fed operations. But expectations are for the operations to slowly decline as the week goes on. I'm Greg Faranello, and this is Monday Minutes.